like to introduce as our first speaker, Sandra Macleod, who is a partner and director at Reputation Dividend. Her work and Reputation Dividend's work, as I just said, focuses on the kind of reputational boosts and other tangible benefits that companies get from working on CSR and sustainability. So please welcome Sandra to the stage.
Good morning. Good morning. What a pleasure to be here. I've never been called a backup band before, but obviously I'm the warm-up act. In your program, some of you will have seen originally this was destined for someone called Simon Cole, who's the founder of Reputation Dividend. Sadly, he couldn't fly this week, so I'm the replacement, but hopefully I'll be able to share with you some, not necessarily the cure to some of your ills, but perhaps some solutions and maybe some ideas that might be useful as takeaways and things to think about. So, what I'm going to talk about actually touches on some of the things we heard last night. And I was delighted, having just flown in from London, that I resisted the call to go straight to bed, which is what I wanted to do at 5, and I came in here and was so energized by the discussion, the reception, what all of you do, that it's really useful as a scene setter for what I'm talking about now, because we talked about some of the direct and indirect benefits of the work you do, of the strategies you embrace. And this is one of the things that I think is very exciting, because certainly in the publicly quoted sector, listed company sector, there is a way to clearly demonstrate the impact of all things corporate responsibility on share price performance. And that's really what I'll be sharing with you now. Just by way of background, Reputation Dividend is a British-based company, although we have clients around the world, and founded in 2010, really just purely doing that, looking at the economic benefit, if you like, of corporate reputation and the different drivers of corporate reputation, of which corporate responsibility, and I use that term in the broadest sense, represents. And we support clients from A to Z and across all sorts of different sectors. And it's a real privilege to work in this area, because what we do, by and large, goes into boardrooms, goes into executive committees, and puts up a mirror and says, this is why what you do, what you say, what you embrace matters. And if all you care about at this level is share price performance, I can actually show you the value. Now can we talk about all the other things that go into this and support it? I don't need to go through this. You've been doing some extraordinary work. I love your 22 studies, the case studies that you've been developing, and the different aspects that actually point to the business case of all things sustainable. And clearly, from an investment perspective, the investment community is there. And again, we touched a little bit on this yesterday in terms of all the different ESG companies and how they're performing, certainly the SRI funds, and generally the investor interest is growing. I've been in the world of reputation research for about 30 years. And I remember back in 1992, one of my clients, in fact, a colleague of Adam's, a chap called Dominic Fry, was at Sainsbury's at the time, now is at Marks and Spencer's. He came to me and said, could we start to look at the impact of CSR on reputation, on behavior, on effectiveness, and so on? And that was pretty prescient, because in 1992, not much was going on in that space. And it stayed with me for a while, and I kept on thinking, how do we disassociate corporate responsibility, strategies, actions, implementation from all the other things that an organization does? And it was actually, we did a lot of studies around the impact of reputation on organizations and where the media was going in this area. And we could see that there was a huge amount of interest in all things corporate responsibility. But a lot of those early studies were, I won't say greenwash, they were the early attempts to say, we want to do something different within our organization. And we track that. And we also tracked not just the reactions to such programs, but also the blockages to such programs. And the blockages through the late 90s through to the early 2000s were always the financial community, both externally and internally. So the investment community initially has been very reticent about this and saying, well, it's woolly, it's not defined, it doesn't come into how we think about an organization. Fast forward to nowadays, and it is clearly there, and it is clearly present, and we see it driving behavior and, importantly, investment decisions, not just in the specialist funds, but across the board for the S&P and the FTSE. And I'll show you how that comes through. And, of course, you've got, from a business case perspective, delighted to see that it's coming more and more into the business schools, but also we've seen some very significant reports from Ernst & Young and others talking about the impact from a business perspective of all things CR and S. When you think about reputation, and you have to define reputation, there's a lot of things that go into people's minds around what makes up reputation. The thing that interests me is less the definition, but is more of how does it actually drive behavior? What is it that factors into one's mind that actually means I want to stay loyal to you? At a share investor perspective, it means I want to buy your shares, stay loyal to you through good and bad times, continue to invest in you as an employee. Again, all the other aspects that you can think about driving behavior, really reputation is at its core. Yeah? And that's fundamentally why reputation matters. It is a driver of behavior. And one of the fundamental principles about reputation is always the question of reputation for what, among whom, and to what purpose. Okay? So you can think about that from a number of perspectives. Obviously, employees. You can think about it from an NGO perspective. You can think about it from a regulatory perspective. You can also think about it from an investment perspective. And I need you to bear that in mind because that's what I'm talking about. I'm just taking that one stakeholder, that one segment, and saying what's happening at the investor level. What we see, they all talk about rational markets and the rationality of investors and analysts. Well, they're not rationals. They're human beings. And like all human beings, they're influenced by a number of things. Everything from their view of organizations in terms of its profitability, the allocation of capital, perceptions of management, what's happening in the sector, again, hugely important. What are they doing in terms of marketing, advertising? What does their future look like? A whole load of things go into their perspective about an organization's reputation. A lot of things feature in. And what comes out fundamentally, and this goes back to this issue of its driving behavior, is that from an investor perspective, it actually underpins confidence, or otherwise. And we see some organizations whose reputations are toxic, and when you look at their market cap, it's below all the tangible assets that they actually own. And why is that? Because their reputation is toxic. At the other end of the spectrum, you have a certain amount of tangible assets, and the market cap is way above and beyond just the tangible assets. So what's happening? What's happening? And what's happening is confidence. And what's driving that confidence is reputation. So we often say what gets measured gets managed. I will also add what gets measured gets done. So be careful what you measure. And finally, I would say what gets bonused really, really, really gets done. So I spend quite a bit of time talking to companies saying, okay, you've got all these KPIs, you have all these metrics, talk to me about your bonuses and your bonus systems that drive the behavior that we want to see as an organization. How connected are these? And that's still has yet to be fully addressed as much as I would like to see it, certainly. So something to be mindful of and something to be careful of. When we're looking at reputation value, and this again, reminding ourselves, it's from the investment community perspective. What we're doing here, just to sort of deconstruct the model before I get into some of the findings, is that this is purely mathematical science at work. It's regression mathematical modeling. And we're taking in a host of variables across all of the S&P, across all of the FTSE, saying what are all the different, probably about 45 different financial variables that companies will report on, and you'll pick them up in facts at Bloomberg, annual report and accounts. We have all that going back 9 years in the US and about 20 years in the UK to understand how the market assesses companies. So how are they affected by tangibles that actually lead to the market capitalization, and where is there a difference? We also feed into that modeling reputation data. And the proxy reputation data we take from is from the world's most admired studies that are done by Hay here in the US for Fortune, and in the UK for Management Today by one of the top business schools. And they're done year by year, the same basis, and by and large go only to the, what I would call the investment and the opinion forming segment. It doesn't go to Joe Public. It goes to those who are the investment analysts, the people who follow the sector, people who are in the business, who understand what's happening. And so we take all that reputational data, both which is published, but also which goes behind the scenes to get to the numbers that they have. And we work through saying, do any of these figures stick? Do any of these figures start to account for why there may be differences in market capitalization for some companies that have the same kind of financial data compared to others? And you start to see that reputation, the element of intangibles, plays a significant part. And on average, it's anywhere between 20 and 30% will actually provide that difference between tangible and intangible value. So we take hard financial metrics, quantitative reputational data metrics for the entire S&P year after year after year, and understand what sticks. We let the numbers come out. We let the numbers tell us the story. And within that, when we start to get the numbers coming through, there's an element of media analysis just to put the context to say, why is it coming through the way it's coming through, and what's behind this? So that's the model. And some of the findings become very interesting, because what you see is that confidence can underpin companies to deliver economic returns at a varying degree. You've got the top 5, the top S&P 5. Apple, well over 50% of its market cap is down to its reputation alone. An organization with the same financial numbers as Apple, but a different name behind it, would not have the same market cap. Okay. Walt Disney's up there, Alphabet, the owner of Google, ExxonMobil as well, Nike. Together, the top 5 account for $894 billion worth of shareholder value at a reputational level. This is the intangible that's driving the market capitalization. Okay? At the bottom end, you've got actually reputations destroying market cap. Their reputations are toxic and actually pulling down what the financials are delivering. And in here, you've got organizations like Yahoo, Avon, SuperValue, a couple of others sitting in there. Yeah? Overall, what we see is reputation is a major corporate asset. Yeah? Across the S&P 500, market cap grossly of the S&P 500 is about $20 trillion. About 20% of that is down to reputation. So you're dealing with some $4 trillion worth of intangible assets. And that's conservative. That is conservative. We know that. We've proven that year after year. If you think about that and just stand back at this level and say, what asset in any organization goes so unaccounted for, unprocessed, unmanaged, undirected, that has such significant value? That is untenable. And that's part of what we try and do when we go into companies and say, this is significant, boys. Sit up, take notice, men and women, about what kind of asset this is and how you as an organization actually protect it, develop it, and enhance it. So, when we look at all things corporate responsibility related, we also start to see the impact of corporate responsibility, because reputation isn't just one thing. There are a number of traditional drivers of reputation, particularly from an investment perspective. And it's everything from financial soundness, long-term investment potential. You always have J&J and a number of top stocks sitting in there. Quality of products and services, quality of management, people management, use of corporate assets, innovation. And then here you've got social responsibility, sustainability, and all things ESG. And then global competitiveness. Yeah? Those are the different factors that get assessed within reputation. Those are elements that we have data on. And what we see is that of all the elements, so if you think that 20% of the S&P's market cap is down to reputation, 10% of that 20% is down, on average, to social responsibility. That is a significant sum. It's not the biggest driver, of course not, but it's one that we see has been constantly growing and rising over the years, particularly post-recession. In the depth of the recession, the investment community was saying, talk to us about survival because we're worried that you're not going to see this through. But after the recession, it's talk to us about not just your risk protection, which we were hearing yesterday, but also about how you're anticipating a more sustainable future that we should support and invest in. And the finance community is getting this. So we start to see a wide range of winners and losers coming through. Right at the top, you've got the top 10 delivering $63 billion worth of shareholder value. And again, those who have more toxic CSR credentials at the bottom 10. And in the top 10, we have the likes of P&G, Time Warner, Lilly, Merck, and so on. And if I just break that down, one of the things we see is not only the contribution of the different reputation drivers, but also the leverage potential. Where are you doing well, but also if you did a little bit more focus on how much more could you leverage what's happening in your organization. And here, if I pull out corporate responsibility, on average, it's about 10% as a factor contribution to most organizations' reputation, but it has a value potential that actually is probably not fully recognized. And this plays out differently for different companies. And I'll show you in a moment. If I pull out Merck, for instance, Merck is very highly regarded for its corporate responsibility. It's contributing about 7.5% towards its overall reputation value. But it also has one of the highest factor growths, along with innovation, which again you see in the top left-hand corner there. So not just how much it's contributing, but how much more, if you paid attention to it, could it deliver. And then you've got Monsanto. Toxic on CSR fronts. If they got it right, it would add $2.5 billion to its market cap. Okay, so the good and the bad. So just to wrap up, the investment community is seeing this, and it can be quantified. And if you need to bring on executives and boards to actually the importance of what you're doing, and again, yesterday we touched on the direct and the indirect benefits, you can say, let's look at just the tip of the iceberg. Already from a market capitalization perspective, this is huge, and it's important. Yeah, and the benefits are considerable. Most companies tick on at the 3%, but those who really make it strategic, like the Unilevers, like the M&Ss, like the Intels, some wonderful case studies you'll be hearing from in a moment, that the investment community sits up, takes notice, and gives credit for, and it's significant. And also, there's so many organizations who are doing really interesting things in this area, but don't actually talk about it. The narrative isn't strong, the cohesion just isn't there. If they get that right, that will come home. So, I hope that's given you food for thought, and that's been a sufficient warm-up act to our case studies to follow. Thank you so much for your attention.